All right, welcome to another episode of Future Money, where we talk about the investments of the future
that make us money.
All right. Please remember that nothing we say here should be taken as personal advice. The conversation is for entertainment purposes only. If you have questions about your financial situation, please talk to a licensed financial advisor.
All right, Thanksgiving episode.
Yeah. The theme motif is giving thanks.
Yes.
Our second to last, or penultimate, is a very exciting word to use, episode. And apparently our 49th.
49th, yes, baby.
And so we're going to have a special, hopefully 50th episode next month to close the year out.
Yeah, we're going to close. We're going to have a lot. We're going to plan a lot of stuff for a party. So if you're a fan of the show, let us know. Definitely want to invite you to the office.
Yeah. It'd be amazing.
And but yeah, it's really it's been an amazing journey.
I can't believe we've done this for 3 years now, Hatem. It feels like more than 3 years, 4 years.
Yeah,
man,
and the feedback has been fantastic. So,
only good things to say about us. Nobody has ever had a bad thing to say about us.
Yes, right.
But no, it really has been.
You gotta have some, some shit talkers, in order to
obviously. I mean, how are you gonna know that you actually have a podcast if people are not shit talking to you? Like then you're just selling it to nobody. Then 2 people are listening,
right?
But it is Thanksgiving on Thursday. We are shooting this on Tuesday. So, I think we're going to do a little bit of a recap.
Yep.
Right. We're basically through earnings seasons, a couple companies to report still. But we're 95% of the way through earnings.
Yeah.
So we'll do a little recap of earnings.
Yeah.
Talk about some year-end planning.
Yeah.
And like I said, giving thanks.
Yeah, giving thanks. I mean, I think we should start there. It's really, I was writing my weekly commentary yesterday, and I'm just really grateful about. I know it's been a really tough year for a lot of people.
Yep.
A lot of volatility, obviously political. There's a lot of issues in the world, stuff like that. Yet we seem to be doing really well for our clients. We seem to, all of us are doing well personally, and super grateful for our clients really to keep trusting us. And
for
really,
sure, for sure, we're grateful for our clients for 100%.
Yeah, and also being in front of a lot of amazing opportunities. We moved into a new office. Yep. The firm is doing really well. We're going through some really fantastic digital transformation type stuff.
Yeah, all of which are going to benefit our clients.
Yeah.
Hugely.
So and also the feedback has been fantastic, right?
Yeah.
We've rolled out a few things for our clients, and so far what we've done is good.
Yeah, we've spent, for those of you who don't know, we spent this whole year basically doing a complete physical and digital transformation of Gerber Kawasaki. And for those of you who have been to the office, you've seen the physical transformation, which is, we love this office space. And the digital transformation is kind of now just it's rolling out to clients.
It's on the back end has been fantastic. The way we trade, the way we manage assets, the way we communicate, the way we build our systems,
our portal so that clients can log in.
So a lot of stuff that you don't really see, but it's been a lot of work on the back end. And I think in the time of AI and it's just came as a really opportune time to be able to kind of build a lot of these things, because we're really kind of putting ourselves in a way to be able to really kind of step into the next phase of this really amazing new world that is driven by agents and AI and things like that. So I think I feel good about where we're going.
I agree, and it will help our clients a lot as AI siphons through the large amounts of information we have on each client, let's say, that I have on my clients, that you have on your clients, and just be able to serve them better, more efficiently, quicker, better results.
Yeah.
So we're excited about it.
Yeah. And also excited to be in the forefront of it, right?
Yeah.
Because I don't think a lot of firms are going through this process, and it's really hard, data lakes and trying to kind of clean up.
Data lake is a term I learned recently.
I know.
I was like, what?
It's a lake of data.
It just sounds like there's just it's just this big old thing that you don't know what to do with.
Yeah. What we learned is AI doesn't work unless your data can talk to each other.
Yeah.
So
unless your data lake has a river to connect it to the next lake, I guess.
You can tell we're both tech people.
Yeah, we're super tech people. But like Hatem was saying, we're very thankful for our clients, for Gerber Kawasaki, for the people listening to the show, for our amazing staff like Alex and the people who produce the show.
Alex, Chase.
So thanks everyone. And without further ado, let's just recap earnings real quick.
Yeah, so we're 90% basically in the earnings season, and S&P up 13% year over year.
Yeah. The earnings or the stock market? It was almost identical.
It was almost identical, right?
Which is not an accident.
Yeah, really not. They don't necessarily have to match, but it's really funny that earnings are up 13%, the market is up 13%. It just feels crazy because we were down 20% in April, and then we had a run up,
straight rocket fire.
Right,
up.
Exactly. And we just went through a small correction, a 5% correction last week, and I think we're overdue for more volatility.
Not even a correction, a pullback, right?
It's a pullback, right.
Not even a correction.
Yeah, it's just
no, correction or pullbacks, corrections, they're all healthy. They're good for markets. We talked last few months, right? We've kind of been focusing a lot on AI. We talked about the pockets of the market that were hugely overvalued. That dreaded company that I hate talking about, Palantir, kind of went down. A lot of those companies went down 20-30%. As people got spooked in the AI trade, and it's always important for people to know that there's no free lunch in the stock market or in any market for that matter. So you're not just going to buy a stock that is hugely overvalued or Bitcoin or Ethereum or whatever, whatever high flyer you're trying to purchase and just expect to make money the next day, the next week.
Volatility is the price of long-term returns. If you're not willing to see your account, your assets go up, down 5, 10, 20% over time, you don't deserve the long-term returns, right?
Yeah, but it's important because people get swept up in the mania. We talked about bubbles last time. We talked about some pockets that were bubbly,
right.
But not a bubble in the space per se. But it's important to continue to be disciplined, even in times where there is market excitement or euphoria even. And I have clients who were calling me, telling me to buy them all these high flyers when the market was already up so much. And we have to help people maintain discipline. Right. And that's one of the reasons you work with a financial advisor, is to tame you when things are going too well, to help calm and sort of revert it. And then when the markets are pulling back, when people are scared, to do the same thing in the other direction and say, listen, this is normal, right? We want to make sure that we take advantage. If there are opportunities, let's take advantage of them.
And this is why we look at earnings, right? Because at the end of the day, the reason why the stock market over time goes up is because companies make more money and they grow, right? So when we say earnings went up 13%, what that means is the S&P 500 companies in America, the 500 largest companies went up 13% or earned 13% more in profits, right? And that's what's driving stock markets. And usually earnings keep going up. Whenever you see a recession, whenever you see a negative kind of turnaround or we go through, bad times, earnings will shrink or earnings will go down. And that's when you see stock markets really retract, right?
Yeah. And when you have stocks,
it's not a perfect relationship.
It's not a straight line. It never is. But it's important to know when you have a stock that is very highly valued, that when the market corrects, it's almost always going to correct
more
harder. And so if you buy a stock that's really aggressive and the market goes down 5%, you might be down 20. They said something like 40% of company or 30% of companies, something like that, in this 5% pullback in the market, we're actually down 20%.
Correct.
Right? Because but these are the companies that had gone up.
And that's
so
the
much.
risk of owning individual stocks, right? Like when you own an individual stock, you expect to have more volatility versus owning an index, right?
Yeah, totally. But earnings were great.
Yeah.
Obviously, the Mag 7 leads the charge again.
I'll go through these numbers because they're really fantastic. 95% of companies reported 13% earnings growth. 8% revenue growth.
Yeah,
Okay?
and that's huge.
That's insane.
Because you can't financially engineer revenue. Like, that's sales.
Yep.
Earnings, you can do buybacks, right? You can cut costs. You can do all these things.
Right.
To make revenue is revenue.
Revenue is revenue, right? The revenue beat rate is 76%. 76% of companies beat their estimates, right? I mean, granted, a lot of estimates can be manipulated, but ultimately, when you see companies doing this well, it just tells you that the economy is doing well, right?
Yeah.
And this despite the tariffs, despite all the volatility from political standpoint, all the issues with the wars and things like that, right? So there's a resilience here that is really interesting.
Yeah, but I read that if Meta had a one-time charge from the Brazilian government, if you back that out, I think it's something like 60.
Netflix?
No,
Meta too. Netflix.
Sorry. Meta had a one-time charge. Sorry, Netflix was the Brazil thing. Sorry, you're right. I confused them. But Meta had a one-time charge off also.
Yeah.
And if you take that out of the equation, you're talking over 15% earnings growth, and half of that coming from the Mag 7 stocks.
Yeah. And then that's the other thing. Like the Mag 7s, I know we keep talking about them back and forth, but the half of the 13% came from 7 companies, right? And this is something that we talked about a lot, concentration and things like that. And we talked about the fact that concentration is just part of the game. We've seen this throughout history, right? But it's really incredible that on average, the Mag 7s were up almost 26%.
Yeah.
Right? These are massive, massive companies printing a bunch of money. And this is why we talked about this. We don't think we are in a danger of a bubble bursting, because a lot of this earnings is what's being used to drive this AI kind of buildup, right? So as the more you keep seeing that there is this free cash flow, there is earnings coming in, you see this growth happening, and that needs to be reinvested, then I'm more comfortable that markets can continue to do well. And this is why what actually Nvidia showed us last week is, their free cash flow this year is going to be almost $98 billion.
Yeah, and it's crazy because they've had, I have never seen a company in my career, the only close
It's never
company,
happened.
No, that just and the earnings expectations are so high, and they keep beating them.
Yeah.
And the market has not reacted positively because people are just nervous that this is the best it can get.
Yeah. I mean, people still almost don't believe what's happening.
Yeah. But there's nervousness. How long can this go on? We know that it can go on, but what we're seeing is now Google, for example.
Yeah.
Right.
Hold on, before you move to Google, because I know you love Google, and I want to talk about Google because I love Google.
Okay.
Too.
All right.
But I think a couple of things about Nvidia that it's really interesting, and I want people to think about is that Nvidia had really high expectations going into this quarter, right? Really high expectations.
And every quarter for the last 2 years.
Right? And despite that, they still came in at almost 64% earnings growth year over year. But more importantly, Nvidia, for as long as we've known it, they've always only given us 3 months out. They've never projected their earnings or their revenue for more than a quarter. This time, told us that they have $300 billion in signed contracts for the next 2 years.
Yeah.
So we know
that's good.
You think?
That's good.
That's good. Yeah, $300 billion.
It's kind of good. It's $300
to $500 billion. So it's and this is all the money coming from all the other companies, right? Who are investing in data centers, going towards Nvidia chips, and not just chips, by the way. And this is really important. Is software, is design.
Nvidia doesn't get credit for its software. They only think about the hardware, the GPUs, Blackwell, and frankly, they have a very big software game too.
CUDA is their software stack, and just to kind of put that in perspective, the A100, which is the chips that were made 6 years ago, right?
Yeah.
So supposedly, this is 6 generations ago. These chips are not that good, right? Because there is 5 new generations after. But because CUDA software is so good, their A100 chips are still 100% in circulation right now.
Yeah.
So what they're doing is they're really innovating their software stack to be able to use the older chips to be able to be used for inference
and all that.
I mean, so I mean, we're talking before this about Michael Burry and how he's accusing Nvidia of cooking the books, and this guy doesn't really understand what the heck's going on.
Michael Burry, for those of you who don't know or remember who he is, if you ever saw The Big Short or read The Big Short, he's Christian Bale's character. He's the person who basically kind of discovers the first one to sort of discover the real estate bubble and shorted.
He's one of a few, right?
Yeah. But he was one of the main characters.
Yeah.
And he made a name for himself during that time. But frankly, he's been wrong for almost 2 decades since then.
I mean, definitely a one-hit wonder, for sure.
And he makes all kinds of grand proclamations.
Yeah.
And the latest one has been against Nvidia.
Yeah, he just said that they're cooking the books and they're not depreciating their chips, or at least the way they
or talking about how their only earnings are going up because they're doing 50% of their earnings as stock buybacks. And Nvidia responded to him like, you actually don't know what you're talking about. The RSUs are different than the cash than the stock program.
But I think the reality is there's a lot of noise and there is anxiety around an AI bubble, and we've talked about this a lot. But I think when you see companies like this coming up with numbers this strong, that gives me more conviction, because this industrial revolution that is happening is just getting started. Yeah. Right? And it's not going to be just straight up, by the way.
No, absolutely not.
This is kind of
never will be.
Yeah.
But going back to kind of the Google thing, because I want to
Google on fire.
I mean, Google has been on fire. Google is now approaching a $4 trillion market cap.
$2 trillion since April.
I know. It's crazy. They've almost they've doubled basically. And
best of the Max 7, no?
And today, the best of the Max by far, by the way, not even close this year. Obviously, they had a lot of fears around things happening with AI and how it's going to eat into their business.
I have to give you credit here. I have to give you credit because I remember at the beginning of the year, a lot of people were saying, "Oh, Google missed AI and innovator's dilemma," and and true, right? Like
absolutely true.
Yeah,
but they did something very impressive, and that was disrupt themselves.
Yeah,
and it's very hard for a company to disrupt their core business.
Yeah,
and to integrate it into their core business, and obviously they had a little bit of luck with the antitrust stuff happening at the right time.
Sure.
With that sense. But
what antitrust?
Yeah, exactly. Well, I mean, it happened to happen during a time where they were losing share of search.
Yeah.
And so it kind of worked out in their favor. But now their chip game is now what everybody's talking about. So they're kind of going the opposite of Nvidia that made hardware that's going into software. And Google's mostly a software player that is now apparently has really good hardware. Their TPUs. Meta just said that they're going to be using Google GPU or TPUs as they call it.
Yeah.
And it is, it's a threat to Nvidia.
Yeah. So what TPUs are is basically custom silicon that Google has used, and the reality is what happened is because you need a different way of managing your data.
Yeah,
if you can kind of create your own chips, then you maybe be more efficient, and that's really the value that the TPUs that Google has done, and they've been doing this for years. By the way, remember Google actually is the company that wrote the white paper about Transformer that made
AI based.
AI based.
I mean, Google DeepMind is like they are the OGs essentially.
Correct.
And the release of Gemini 3 was a huge release. Outperformed Chat GPT by a lot. Yeah. Apparently, I heard today Claude Opus now outperformed Gemini 3 as of yesterday. So these models are like, and granted, it's like their own, AI has their own like standardized tests that they run these against. But Gemini 3 is amazing. If you've used...
Well, I think Google's Gemini 3 biggest value is being incorporated within the whole Google ecosystem.
Well, that's Google's moat right now, is that everybody Googles everything.
Gmail, Drive, all that,
and
search.
And that's the thing like that everyone was nervous about. But if I can control that, and then now I can have hardware on top of that. And when you search something now, it's really cool because like I'll search whatever, show me NVIDIA's earnings, whatever the case may be. And obviously they have YouTube. And the AI will take you to the moment of the YouTube video that looks at what you're looking for. So it's like 2 minutes, 38 seconds, you know?
By the way, YouTube is the biggest data trove ever created.
And obviously AI is going to help them, and you add the hardware component now. You add search. I'm sure they're not even close to monetizing this. Now you add Waymo in the coming years. Like, I mean, Google's position, like we thought that there was a chance that their moat was going to be attacked. And in fact, it looks like it got bigger.
It got bigger.
They put alligators in their moat now.
But also like this, I don't think this is a threat to Nvidia because the compute need that we have, it's I don't think people understand or appreciate how much more compute we need.
I don't think it's a direct threat, meaning like Nvidia is going to go out of business because of this. But you know, Nvidia essentially was kind of the only game in town. And what, you know, obviously Broadcom, you know, makes custom chips, and AMD has what I honestly think are second-rate chips. But a company like Meta, who's obviously a $2 trillion company, coming out and saying we're going to use Google, which is ironically their competitor.
They're not just going to use Google.
Of course,
they need to diversify.
They all like to make these proclamations, you know, online, and the market reacts immediately because of that. But like you said, it's what Elon Musk used to say about Tesla when EVs were first coming out. He said, we can't be the only EV company.
100%.
You know, we need everybody to adopt this so that it's a real thing.
So that's really, that was earnings. So super excited about that. Margins also held up quite well.
Margins did well, but you know, it's important to note the distinction, right? AI is doing really well. Food companies did very poorly. Right? Travel's going to hurt probably because of what happened with the shutdown.
Inflation is still sticky.
Inflation is still stickier. You think it's going to be over 3%, you know? So there is like a bifurcation of
tale
of the market.
2 countries, basically.
Correct. And I think a lot of people are feeling that, and we're on this podcast talking about all the stuff that's going well. But it's important to note that there are sectors of the market and there are sectors of the economy.
Real estate still struggling.
That are struggling pretty heartily. And so knowing that it's not just a buy anything kind of market. Earnings were great. I do think the margin thing was great, and
I mean we try to look beyond just the headlines, right? Like margins are important because it shows you that companies are being more disciplined. You know, obviously that also has an impact on hiring. A lot of companies are not hiring as much because there is efficiencies being created by adopting AI.
And the idea is the margins should continue to go up.
Correct.
And unfortunately, at least on the short term, that might be at the expense of hiring.
Right. 100%. And this is the reality, right? So, you know, there is bigger themes are working themselves out around education and hiring and skills, you know, and these are the things that we have to look at over the next few years. But that's the reality. Like the genie is out of the bottle. You know, you just have to adapt and
you adapt and adopt. If you adopt, hey, you'll be fine. If you shy away from it, you're unfortunately not going to catch up with the rest of society.
And the other thing, the other positive that's happening is tariffs are not being as hurtful as they were. Also, the fact that the Trump administration is kind of, you know, starting to cut some deals, or at least
roll them back. Let's call it
rolling back some of the tariffs,
like coffee now, and all the stuff that you know, and you know, for better or worse, Trump saw that coffee and you know, some stuff are sort of getting too expensive, so you know, trying to cut tariffs on that stuff. So regardless of how you feel about the tariffs in general or his administration, at least he is responding.
There is a realization that some of the stuff is hurting, which, you know, by the way, tariffs are a tax. That is a fact.
Are they? Is that what it is? It's literally just a tax. It's a tax on imports.
That's exactly it.
That's if you look up the definition.
So that's where we are. So that's all those undercurrents are playing out. So
but that said, you know, we kind of, like I said at the beginning, we kind of want to make this show not just about AI, not just about this. It's Thanksgiving. We want to talk about things that, like we said, giving thanks and giving in and of itself. So at Gerber Kawasaki, we really truly believe that, charitable giving and helping and is helping in the community, however that is, or whatever causes are important to you. We highly believe that as investors, as humans, we have an obligation to do these things.
Yeah, but not only that, like we're successful, grateful for all the luck and all the, the great things that are happening for us. And part of like showing that gratefulness is really being grateful is just being able to give back and to causes, and the U.S. system is really unique in a sense where it really provides for entrepreneurs, successful people to really have ways for them to give and support causes, right? Like the Americans are, by far give the most out of any society ever, right? Because the way that it's set up, the incentives are to, if someone is successful, they want to give back and really help other nonprofits and things like that, right?
Yeah.
And there is tools to do that.
There are definitely tools, and, you'll get the criticism that, rich people, they use these things to get tax benefits. Who cares? Let's give us a tax benefit for helping causes. That's ultimately what matters in the end.
Listen, it is what it is. Taxes drive a lot of decisions.
Yeah, money in general drives a lot of decisions, right? Morals are great, and everyone should have them,
right?
And high morals,
right?
But in the end, a lot of decisions are made based on your wallet.
Correct. Yeah.
And so
why not save money? Would actually feel good about it.
Correct.
Do the right thing.
Yeah. Incentivize people to do it. So there are definitely a few ways that you can do it before year's end to contribute. It's important to note that in the new tax bill this year, there is a change.
Yeah.
There's a small change, but a significant one nonetheless, in how charitable gift giving is done. So basically from 26 on, there's going to be a 0.5% reduction from your adjusted gross income of what you can give to charity. So basically the first 0.5% kind of doesn't count.
Doesn't count, yeah.
So for easy numbers, let's just say you make $100,000.
Yeah.
Right? And 0.5% of that is $500.
Right.
So the first $500 you give to charity kind of don't count.
What if you made $500,000?
Right. So if you make $500,000, that's $2,500.
Right.
Right. So it's important to note that for a couple of reasons. One is obviously to know what the law is, but if you are charitably inclined, and you plan to give something over the next 1, 2, 3, 5 years, you can front load it this year.
Yeah.
Right. So if you
get 100% reduction in 2025.
Exactly. So if you make $500,000 and you want to put, your plan was to put, $10,000 a year for the next 3 years.
Maybe do
$30,000 this year. And you can do it. You don't have to donate all $30,000 to charity right away, right? We know that there's ability.
Our favorite is
the donor advised fund, right? So tell us a little bit about the donor
advised fund. Is basically it's a charitable account. You can give cash, or most people would give appreciated shares into it.
Yes, it's much better if you give appreciated
exactly.
assets.
And what it is basically a charitable account is irrevocable. So once you do it, you can't take it back. And what happens is you can control those assets, so you can gift as you wish.
Yeah.
So you put money in at once, you take the deduction when you do it, but then you can give it over time, right?
Correct.
And we manage a lot of these charitable accounts for clients. It's a really fantastic way to control when to give, who to give to. When to do it, so it's a really nice way where you can control the
and it's a really good way for people who want to give. Maybe they have appreciated assets. We said, this is kind of the best way generally to give in these donor advised funds.
Yeah.
Because let's say I bought Nvidia, right, and my cost basis was $10.
Yeah.
And now it's $175.
Yeah.
Right. And I don't want to sell the stock, pay taxes, and give to charity.
Yeah.
Right. So I can donate $10,000 in Nvidia stock.
Yeah.
That I get the full deduction the second I give it.
Yeah.
Right.
Market value at the day.
Market value of that day. Then when it's in the donor advised fund, I can sell it and diversify.
Sure.
With no tax implications.
Yeah.
Do whatever I want with those funds.
You don't pay capital gains.
I don't pay capital gains.
Right.
So you're kind of checking a lot of boxes here if you are charitably inclined.
Yeah.
Or you can leave it in there and hope that it, if you want to continue to have it go up.
Yep.
But the idea that you can invest and trade it without any gains is really important. And then you can give some today. You can grow it for the long run. You have 10 different causes you love. You can kind of do whatever you want with it. Which
this is frankly one of the easiest, best ways for people to gift. I have one. A lot of the partners have one.
I have one as well. Yeah,
a lot of our clients have one. It's easy
and it's important. It's important to me. I know it's important to you. To give to causes. And also, again, to manage concentrated stock positions that are highly appreciated that we might want to diversify, but we'd rather give them to charity rather than just
do the
sell
right
them.
thing and feel good about it, right?
Correct.
Like, you know, personally save on taxes, but also, give it to the right nonprofits or charities. So definitely, if it's something that you haven't thought about or you haven't talked to your advisor about, talk to us. We definitely can set that up.
For sure. There's other charitable stuff, right? You can give directly. You can do what's called a qualified distribution from your IRAs. So if you're taking distributions from your IRA and you don't need them, to avoid the tax that you pay on your IRA distributions, you can just gift that amount to a charity, and you don't pay taxes on that. So those are a great way. And then there's more complex stuff, which may or may not make sense for people. But there's a lot of ways to give to charity that are both beneficial for charity and for you.
We're just scratching the surface. Like there's a lot of cool ways for you to structure different different situation. Maybe if you have an exit, or if you have a huge capital gain, or if you're selling a property, or even have private stock. There's definitely a lot of ways
for sure.
And this is kind of, we love doing this stuff and kind of figuring out if you're charitably inclined, what percentages we can do towards this or that. So we really come up with really cool ways and plans to do these things, and you don't have to do it all, by the way. It's just a percentage of it,
of course.
So it's really this is the time to start thinking about this stuff. And that's why we want to talk about it today.
Yeah. And then lastly on that end is like, as we're talking about sort of like last minute year-end stuff before, like things to do before the year's over, right? Charitable giving is one of those things.
What, 6 weeks to go? No, 5 weeks.
5 weeks.
It's insane.
And let's, the last week, everything's kind of, everyone's kind of out, out of it already.
It's really hard to, it's amazing how fast this year has gone by.
That's right.
Yeah.
So just like a checklist of some things that people should be doing before the year's end, at least thinking about, right? So we talked about charitable giving. We talked about required minimum distributions from your IRAs or your 401ks. You can do both together, as we talked about. So make sure you do those. There's a pretty heavy penalty for not doing your required minimum distribution.
50%.
Yeah. So you got to make sure you do those. Make sure you max out your 401k.
Yeah.
Right. This year, it's going up again. The number is going up again next year to over 24,000. So obviously you have to do this.
All these have to be by December 31st, basically.
Right. Roth conversions.
Yeah.
Something that a lot of people don't talk about.
Yep.
Like you have all your money's pre-tax, right? Because it's in a 401k. But maybe you're retiring, or maybe
talk about a complex transaction.
It's amazing in the right scenario for a few different things, right?
Right.
It is complex, but we help our clients do it. We can help run projections with accountants. But if you're in a lower tax bracket now, and you want to convert to have pre-tax money become post-tax tax-free money, it's amazing for yourself. And especially for legacy planning.
Yeah, for your kids,
right? Because that's tax-free to them for at least for the first 10 years that they have it after they inherit.
Yeah.
So it's a great strategy to do before year's end. Tax loss harvesting.
Yeah.
Tell us about that.
If you have any losses.
If you have any losses, which, you might.
Yeah.
There might be some.
It's straightforward, right?
Yeah.
If you have capital losses, or you buy a stock and it's down, just sell it before the end of the year and take the loss against your gains.
Yeah.
That's pretty standard for us. We do that.
Yeah, we do that manually all the time.
Yeah.
You can also buy that stock back 30 days later.
Yeah.
Or, if you own ETFs or funds.
Doesn't matter.
The best way to do this is like, you own the S&P 500 fund, and you sell you're down on it, and I don't know where you would be, but let's just say you are. You sell that, and then you buy the U.S. total market index, which is like 99% correlated to the S&P. And then you hold that, and in 30 days, if you want to change back, you can. If that ETF runs, and you can hold on to that. So it's kind of the same. So tax loss harvesting does actually help a lot.
And by the way, like besides the fact that it makes sense from a tax standpoint, hanging on to your losers is not a good strategy.
Not a great strategy in general.
In general, right? We run across this a lot. Like some people would buy a stock or a company and like, oh, we're waiting for it to come back. Remember, if a stock is down 10%, it needs 20% just to get back to even. If it's down 50%, it needs to double just to get back to even. So I think you have to think about in these numbers, and also don't really have emotional attachment to stocks. And this is kind of the stuff that you have to think about.
For sure. Run some tax projections if you need to. Another change in the tax code this year, which is really important, is the SALT deduction. Right, the state and local tax.
I'm so confused.
Deduction. So you come to the right place, Hatem, as the person who actually summarized the tax document for our firm.
There you go.
So if you live in a state like California, right, you have a state and local tax limit of $10,000. So if you've done $10,000, which anybody who has a house or anything like that is that get used up like that in LA. But in the new tax bill, you can do up to $40,000. If you're under $500,000 in adjusted gross income, if you're married filing jointly, right? So if you're under $500,000, you now have up to $40,000 SALT deduction. That's huge. That's a really big
most
tax
people
deduction.
Are under that $500K, and most people
exactly. So if you are, it will save you a lot of money on taxes in doing that. Between 500,000 and 600,000, it starts to phase out, essentially. And once you hit 600,000, it goes back to the limit is 10,000 again. So it's important that if you're anywhere near the cusp, remember that things like 401ks and all these deductions count, reduce your income. So if you're anywhere close, I've been talking to my clients about this a lot. If you're close, let's max out your 401k.
Max out your contributions.
Max out your contributions. Do your HSA, which we can talk. So anything that can get you below that 500,000 hopefully threshold is going to be a huge benefit to you tax-wise. Not to mention you're going to get a tax deduction on top of that, putting that money in. Right? So it's a pretty big planning thing you want to do before the end of the year.
And again, everyone should think about these things, right?
Yes.
This is kind of why we're talking about this
for sure.
Talk about it with your advisors. We talk about it with our clients. So.
So we talked about HSAs. Make sure you have your HSA maxed it out for the year. If you have a flexible spending account or an FSA, you gotta deplete that before a year's end, right? So go. If you haven't used it all and you have $500 left, I don't know, go buy some new glasses, and use it.
Go see your doctor.
Go see your doctor, and maybe do an MRI that you needed to do over the last 2 years.
Grateful again for another year. Grateful
and annual gifting, don't forget that.
Annual gifting, that's right.
You got a
big one. Yeah, 19,000 this year. So how that works is all of us get to gift up to $19,000 per person every year without going against our lifetime exemptions. And what that means is I can gift $19,000 to anybody I want. Without them paying tax, without me paying taxes, right?
Exactly.
Obviously, I don't know if most people want to give $19,000 away, but this is grandparents for people,
college,
529, college. It's a really cool,
or a way to just transfer assets from one generation to another without estate taxes, things like that.
100%.
So it's really good. So I felt it appropriate to end on the note of gifting. Considering we are going to Thanksgiving and now to the holiday season. Right. Be thankful and give. Charities, gifting, all this kind of stuff. It doesn't have to be stuff, you know. We all have enough stuff, you know. We have a lot of stuff.
Yeah. Well, I'm super grateful for you. Another great year. Another awesome year here at GK at Future Money.
Yeah.
50th episode coming up next month.
I love it.
Gonna have a party. Gonna have a fun closing of the year. Hopefully things will hold up like they have. And
grateful for you, Hatem, for your radical optimism always, and for this show, for us being able to do this for years, just to have you as my partner.
Yeah, likewise.
I appreciate you.
Likewise, man.
All right.
Cheers, bud.
Cheers.
All right.